You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. It is a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit orats.com or email Matt Amberson at matt@orats.com. And now, it's time to learn how to implement options in your practice. It's time for the Advisor's Option.
All right, everybody. That music means we are back once again. It is time to roll out the shingle. Yes, it is time once again for the Advisor's Option, the program for you busy financial advisors and asset managers out there. Maybe you're options curious, dare I say. I know a lot of your clients probably are. Or maybe you just want to know what's going on in the world of options, but we get it. You're busy out there actually dealing with your clients day in, day out. Either way, we've got you covered here on the Advisor's Option. My name, of course, Mark Longo from the THE, optionsinsider.com, as well as from the network upon which so many of you are mainlining these days. Remember, if you like what you hear, this show, anything else on the network, a like, a star, a comment, a rate, a review, whatever your platform lets you do, all of that in aggregate does help new people continue to discover the content. And there's new people out there all the time. They are legion. And if you want to go above and beyond, maybe you have some more questions about options that go beyond the scope of this show. You'd like to have them answered by some of the best minds in the world of options and derivatives. Maybe you like a little bit of unusual activity. You want live access to all of our content we have out there. You want access to 300 plus episodes we have on that pro podcast feed. Only one place to go. The optionsinsider.com/pro is the place to go to learn more, get access to that. By the way, we have a fun bonus for that, which is, of course, our pro trading crate, which the next one will go out in a couple of days. March drawing to a close soon. So if you're listening to this before the end of March, make sure you get in there, theoptionsinsider.com/pro, the place to go to learn more. As we go around the horn, learn who's joining us on the show today. First, let's go out to the shores of New Hampshire. Yes, I said shores. Everyone forgets. There is a shoreline there. It's about 5 miles, but it does exist, where we are joined once again by our old buddy, Mr. Matt Amberson, the founder over there at ORATS, a.k.a. Options Research and Technology Services. Mr. Matt, welcome back to the show, sir. It has been too long.
I think it's 13 miles, Mark, but you're right. It's the state with the shortest coastline of any state that has a coastline, and it does. It feels like forever, so it's great to be back. Very much looking forward to doing it with you, Mark.
Well, I apologize for underselling the treasured coastline of New Hampshire. I will endeavor to make it up to you throughout the entirety of the show, sir, as we keep
I could see the ocean, Mark, and only when the leaves are down. When spring is sprung, it's just a tree-lined vista here. But so this is our one chance to celebrate.
This is your scenic time of year. I like it. As we keep on rolling to see who else is joining us on the program this week, I'm pleased to welcome back on Nick GRIEBENOW, the portfolio manager over there at Shelton Capital Management. He last joined us all the way back in November of 2022, so it's been a while. We did have Barry Martin, one of his partners in crime over there from Shelton Capital, on the show last May, but it's been a while since we've checked in with you. Nick, welcome back to the Advisor's Option.
Thanks, Mark. Been a while. Glad to be back. Looking forward to it.
All right, we have a lot of fun to get to today, listeners, so let's get to it. Let's kick it off the way we are wont to do, a little bit of the old P&L statement.
What the heck happened in the options markets since our last episode? Let's find out with the P&L statement.
All right, everybody, let's get down to it. The segment that was born out of the pandemic, listeners, because so many crazy things are happening in the world of options and volatility, literally between every episode, that we always started every episode just talking about that. So it became codified into the show with the P&L statement. And obviously a lot has happened since the last time we chatted here on the Advisor's Option. But to break it down to brass tacks for you listeners, the broad indexes have mostly gone up, volatility has mostly gone down, and options volume has continued to soar. I think I got all those bullet points right. But we'll start with our guest, Mr. Nick, sir. Obviously a lot going on in the world of options and indeed volatility right now. What is catching your eye out there these days, sir?
I would say a couple things. I mean, primarily how low volatility is, not just in the equity space, but across, a lot of different asset classes here. We're seeing atypically low volatility, the VIX being in the 12 handle, 13 range. Obviously, that's a bit of a headwind to generating cash flow and generating premiums here. But other than that, we've had pretty strong earnings season here, market trading at all-time highs. Pretty unique environment to be in relative to where we were over the last number of years with, a lot more choppy trading activity in the market, post-COVID here. So earnings season wrapping up, things are looking pretty strong. We're starting to see a bit more, broad-based performance than we certainly saw last year with the Magnificent Seven dragging everybody up. So, interesting environment to be trading in here.
That it is, Mr. Matt. Same question for you. I know when you're not chatting with us here on the show, you're out there crunching the numbers on this market. We'll get to all the earnings fun that Nick just mentioned in a second. But what's been catching your eye out there in the world of options and indeed volatility since last we chatted, sir?
Yeah, not only has volatility been coming down, but other measures that we look at in our Outlook and our dashboard product is the implied volatility divided by the components of the, let's just say, for example, the ETF of S&P 500. And that's at the lowest that we've measured in a very long time. It's just the SPY. I mean, it's just no fear in the market and just a relentless march up. And it just doesn't feel like anything's going to crack this market. And then as we talked about, I think even in the last show, this contango is, the front month is well below the back month, and that's been something to behold. I mean, that's again getting a very positive bent to the market. That's where you want to be if you're bullish. And then then just looking at the put call slope, it's as flat as it's ever been. since we started measuring it. You know my opinion on that. It's the dreaded zero DTE, and the market maker is able to really hedge off their books real well, and there's no longer that kind of systematic or systemic put buying that, where the market makers have to be short puts, so they could really kind of equal out their book. And I think that's led to a lot of what we're seeing here, as opposed to what many people have said. I feel somewhat vindicated as of saying the zero DT is actually going to be a good for the market and good for volatility in a stable market. So I'll leave it there, Mark, but that's what I'm seeing out there.
All right, you guys both touched on volatility, depression. There's quite the debate raging right now over what is doing that. We'll get to that in a second, a little bit of a tease for the buzz in a few seconds, listeners. But now let's dive into a little bit of the old tricks of the trade.
And now it's time for practical tips on how to implement options into your practice. It's time to learn the tricks of the trade.
All right, welcome to the Tricks of the Trade, where we explain some maybe behind-the-scenes ways that a lot of advisors like to implement options into their clients' portfolios. And, Nick, the last time we had you on, and indeed, certainly the last time we chatted with your partner back in May of last year, the refrain has been somewhat similar to what it is right now, which is we're in a fairly high rate environment. That certainly hasn't changed, despite what the Fed has been talking about since your partner came on a year ago. That certainly hasn't really changed out there. We haven't seen the much ballyhooed 3 rate cuts yet so far this year. And if anything, volatility is even lower than the last time we were chatting about this topic. So an intriguing time to revisit a very important topic for a lot of advisors out there, which is income. In fact, we just polled our audience last week. What is the primary reason you utilize options in your portfolios? And over half said they're out there for the income generation component, premium harvesting. So clearly a very important component for the use case for options, and certainly for the advisors. I would easily say that is the number one use case for a lot of them. Nick, as I mentioned at the top of the show, you guys out there at Shelton run a covered call strategy. So options overlay, your day-to-day job when you're not talking to us is out there getting that income for your clients. But in this environment, you have a little bit of a double whammy working against you. First off, as I mentioned, very high rates. So maybe some of your advisors' more risk-averse clients might be saying, why should I bother with these options things? I can get maybe 5% in a cash account right now without any risk. Inflation, another concern, obviously. But that said, that is kind of the opportunity cost they're looking at. And then also at the same time, we're seeing fairly low levels of volatility across the board, not just in equities, but just about all asset classes that we're looking at, with maybe the exception of energy and crypto right now. So that yield is becoming harder to come by. So you might have a lot of advisors right now, Nick, saying, you know what, why bother? Why should I even bother doing this? The hassle, the risk of trying to generate income, I'll just park myself in cash or in T-bills, take a nice riskless 5% and move on. What do you say to those folks?
Mm-hmm. Well, I would say, in part, you're absolutely right, Mark. There's a number of headwinds here, low volatility, rates haven't come up. In some respects, the ability to get worthwhile yield from sitting in cash or buying fixed income assets can make selling the yield component by itself of a covered call strategy a bit more difficult. And simply put, investors now have other choices for finding yield that, really weren't there in recent years. That said, I think that the overall growth of the derivative income space in general is a big tailwind. We've seen assets just flooding into derivative income funds over the past number of years. And, certainly this current environment that we're in is a bit more difficult to sell a yield component, but it's kind of a rising tide lifts all ships kind of mentality here, where, the general acceptance of option strategies, in public has gone up. Advisors' awareness has gone up substantially, as well as, you can get, I guess, probably 5% in some money market funds at this point, but that really is kind of the top end of your potential return. I think year to date, EQTIX is up about 8% so far. The S&P is up even more than that. So it's certainly an attractive alternative if you're solely looking for the cash flow. But I think these options income funds are still going to be able to generate meaningful cash flow. We've talked about volatility being muted, especially on the index level, but I think single stock, individual stock volatilities, well, they may be a bit muted compared to their historical norms. I haven't seen as big of a hit as, a 12 handle on the VIX might indicate there. And there's still the upside potential of the equity holdings in the covered call strategy, to where if you're happy with 5% and that being the top dollar you can see on your return, you're right. It's a great risk-free investment. You can get that cash flow. But if you're looking for cash flow as well as having some potential to not be left behind by the market overall, there's still a attractive component here to sell with these covered call strategies.
Now, for those advisors, listeners out there looking for a little bit of tricks of the trade, obviously you guys are having to navigate these waters. Do you have any advice for our listeners out there looking to generate a little income? Are you folks having to adjust your overlay strategies in light of this environment, maybe moving, let's say, the covered call a little closer to the at the money to generate the yield you're used to? What are some of the tweaks you folks are implementing over there at Shelton right now?
Absolutely. So I'd say we haven't made too many changes with the way that we have been approaching our call writing. Certainly, we're going to be writing a little bit closer to the at the money level than we were, in higher volatility periods. There's just no avoiding that. But, it's tough to keep up with a market that's shooting straight up. Last year, a lot of that upside was driven by the Magnificent Seven. Plain and simple, we're not going to be keeping up with a stock that, moves like NVIDIA did when we're writing calls against the position. But especially with how many stocks and how many sectors we're not seeing that explosive upside, there was still yield to be had. There's still calls expiring worthless, premium being kept in pocket. We're not having to pay to roll everything out, kind of broadening out the exposure there. And, I think our approach is to stay consistent, stay disciplined, and to not let short-term market dynamics change our long-term approach to managing the portfolio. We'll be a little bit tighter at the money level. We might take a little bit shorter duration with how much the market is running up to avoid, getting buried or left behind on a call trade. But the fundamentals have still stayed the same. And, it's a pretty attractive environment to be selling calls that, never before have been seen levels on quite a few of these stocks and on the indexes in general. We're able to get up to, selling strikes that have never been surpassed at this point, which is certainly a, better approach than having, the market being deflated and having to write calls that are at strike levels that were recently underwater.
And you mentioned curtailing some of that upside. A lot of people would probably look back at 2023, see a mostly straight up year and think, man, it must have been a terrible year for covered call writers. But how was that year for you folks over there at Shelton? You mentioned kind of maybe better than some people would have assumed.
Absolutely. I think that it was obviously the Magnificent Seven dragging everything up. When you're comparing yourself to the S&P 500, it's going to be hard to look good. When you've got those seven stocks, I think they account for something like 60 or 70% of the upside in the S&P in the first two quarters of last year. But, I think that outside of that, it was still an attractive year for a covered call strategy. We were still able to generate attractive, meaningful cash and premiums. Last year, EQTIX was up, I think, 18 and change percent. So we're still, well above the performance of the buy right index, which I believe returned just under 12, trailing the S&P. But again, that's to be expected. If you took out the Magnificent Seven from the S&P, I don't think that the performance is at 26%. That would take a very substantial hit. So all in all, 2023 was, by no means a bad year for covered call strategy. And even on some of the Magnificent Seven, we had a couple of key pullbacks that were, very opportune windows of time to reset our coverage on, Apple, for example. They had a strong run at the beginning of the year, pulled back a few bucks in February. We were able to capitalize on that, had a phenomenal run for the next couple of months, got up into the 190s, and then pulled back again in August. And that was a great opportunity again for us to see some of that, coverage fall off, calls expire. So, there was still opportunity to be had throughout the year, even on those stocks that had phenomenal runs. And I think it was still a good year overall for covered call strategy.
Mr. Matt, same questions for you. Obviously, this is the topic you and I have approached a few times now on a variety of different shows. It's extremely relevant to this audience. Advisors live in that income zone, and it's a challenging zone to live in right now. What are your thoughts for the advisors out there as they're maybe struggling to find income versus their clients just telling them, hey, I'm content sitting with my 5% in cash, Mr. Matt?
Yeah, I mean, ORATS is known for its back testing, and we have now 65 million tests out there, and it just continues to purr. And what we see is what we've talked about a few times is the market can't get the ball high enough when it's high, and it can't get the ball low enough when it's low. What that means is the implied never goes down at the extremes, as far as it probably should, given the historical vol. Never goes up as far as it should, given the historical vol on the upside when it's very volatile. But now, you could still make money with some short vol trading. You have to be, pretty nimble. As far as what we're doing or what I'm kind of looking at now, or we have some shorts out there, some put calendars in case the market corrects, and diagonals. So you're not paying too much for a diagonal. And as the front put comes off, market rallies, you take the front off. You have these little puts that are just sitting there. Always great to have. And then some of these call calendars have been really cheap and really been paying off when the market rips up. So we're looking at those. Some double calendars is how I like to play kind of a short. It's almost like a short straddle, long straddle type thing. That's been working well. But the market now with the PE trailing 26 something, and year to date we're only in a first quarter. It's been up almost 10%, the market. So I think and some of the things that we look at have been so positive, i.e. the volatility just continuing to fall. But now we've seen it as I started at the top of the show talking about the SPY is only 45% of its components. If you look at the IV of the SPY versus the IV weighted of the components, that is extremely low. So can it go? It's hard to think about the vol going lower. That's kind of buoying the market. So you got to have some downside, I think. And so that's the way I look at it. Have some. We've talked about this too. The downside that you have, you can't just buy puts too expensive. You got to find, like I said, diagonals, diagonal calendars, and calendars in order to have some downside protection, and but not get killed on the upside. So that's what we've been doing over at ORATS. Crazy market though, Mark. I mean, this rally is a lot of people scratching their head. 26 PE trailing is just insane. So we'll see what happens, but it sure feels expensive up here, Mark.
We might need to revisit our old 3,000 versus 5,000, Matt. Maybe 3,000 versus 6,000. Is that the next stop? 4,000 versus 6,000. Where are we going?
Who knows where this thing's going to stop? But like I said, it's at these levels, it's very hard to make a case for where it's going to go. The Fed, which is making this thing go it's really the currency in circulation just continues just to grow. There's just a lot of money sloshing around out there. Even though the balance sheet is coming in a bit, there's still a lot of currency out there, a lot of money around looking for homes. There are some places now that you can get decent, obviously, rates. It's pretty incredible. Some of these brokerages, just with money that I have sitting there, they're paying almost 5%. So that's pretty enticing. So it remains to be seen what's going to go on this year, Mark.
And listeners, if you want more detail on what Matt was just talking about, some alternative income type trades, we did do a whole episode back in July of last year, episode 127, entitled Low Vol Calendars. Plus, what we were just talking about, the great 3,000 versus 5,000 debate. So if you want a little bit more insight into what Matt was just talking about, some put calendars and other funky things, ways you can maybe get a little bit of income, a little bit of fun added as well, make sure you check out that episode from last July. As we keep on rolling, listeners, it's a jam-packed show. It is time for the Earnings Volatility Report.
Earnings announcements can move markets, but what is the options market telling us about upcoming earnings events? Let's find out with the Earnings Volatility Report.
All right, everybody, welcome to the Earnings Volatility Report. Again, this is born off a lot of the data that we've been crunching over there on the website, generated by Matt and his team over there at ORATS, in response really to your questions. People were asking us for years, what's going on from a vol perspective during earnings season? How do some of these names perform? What is their historical performance? All very straightforward questions, yet there really was no readily available source of information on that unless you wanted to go find a Goldman study from about 10, 15 years ago, or you wanted to go pay a big brokerage house to crunch that data for you. And I would argue they wouldn't do as good a job as what we make available for free for you folks over there at theoptionsinsider.com. So if you are intrigued by this, by all means, you should be checking out the reports that Matt and his team put out. We put it out all there for you at theoptionsinsider.com. We also tweet it out. You can also find that data over there in the land of ORATs, orats.com. But Mr. Matt, we are winding to a close here on the latest earnings season. And I think the only way you could really describe this season was quite the banger. I mean, we've been crunching this data for a while. Our long-term average is already pretty inflated at 104%. I have a feeling it's going to be moving up after this cycle, though. We're at 127% at the end of the cycle. And the last week of the cycle was 132%. The second week, 137%. Of course, listeners, that refers to 100% being effectively if every name moved as much as their straddle was pricing in going into their announcement. When you have a number like 127%, obviously we're moving well beyond what the market was anticipating from an overall volatility and movement perspective. So crazy times, Matt. This definitely seems crazy when we look back just a few years ago, the depths of the pandemic when we were hanging out high 70s, low 80s percentile. It seemed like earnings volatility had gone to die. And now here we are, Matt, this second cycle, or really the first cycle of the year, just a banger by any definition. Matt, what are your thoughts?
Well, yeah, and hats off to your fans and you for getting us to do this, because what we've learned is during the earnings season, it's very important to look at just the general level of volatility. When we were back in the pandemic and looking at these, volatility was so high, and it was very difficult to get the earnings moves to pay for the straddles that were so high. So, and we mentioned this coming into the earnings season, this earnings season especially, if vol were to stay low, which it did, you're going to get some big moves relative to vol levels, and that's what we're seeing. So you mentioned very high numbers. Usually we're right around 100%, maybe a little bit below of where the actual move versus the implied earnings move. Of course, when we talk about the actual move, that's the move after earnings announcements by companies. So if it's after the close, it's we look at one day, and if it's before the close, we look at that day. And it's not just the straddle that we're looking at. We have ways to really isolate what the actual move of that day is. So, for example, we do look at straddles, and we see how many days to expiration that is, and then we have to then do some calisthenics to get to what the move is just for that day, based on a distribution of how stocks usually move around earnings and how much is going to be the straddle is going to be worth afterwards. It's pretty complicated, but we think we get down to a very good number. We know that because usually it comes in right around 100%, 99%. So that's kind of an efficient market analysis here. And then we could say things like this last earnings was, especially good for holders of straddles around earnings. And, like we said, and we're getting good at kind of predicting that based on the underlying implied volatility going into an earnings event. And we do other things on the outside of this to do some predictions of what stocks we think, individual stocks we think are going to work well, and then some strategies that we have around that. But for the most part, this general earnings season report is pretty striking. I mean, it is one of the larger numbers that we've seen at 27% profit for holders. And then now we're kind of back to what we are used to, is about the third week is the most profitable week. Those types of companies just tend to produce outsized returns, whereas the first week they're the bigger firms, and then the stragglers, they've already kind of priced in a lot. So that's what I'm looking at around the earnings season, Mark.
Nick, same question for you. You mentioned earnings season at the top of the show. So obviously this is a driver when you're out there constructing your overlays. How important is earnings season to what you folks are doing out there? And what are your thoughts on these crazy numbers we were just breaking down with Matt from the current cycle, Nick?
Absolutely. I mean, earnings season is very critical for what we do. Always looking to take advantage of that increase in IV and the greater premium, shorter duration that we can get by writing calls over an earnings release. Obviously, when stocks are making these kind of moves well above and beyond their expected move, in some of those cases, we're going to end up buying those options back and needing to roll them out. But it's certainly something to take advantage of, look forward to, when we're looking to generate yield. I did think that piece that was out on ORETS with the table looking at the expected move compared to the implied move was very interesting data to see. I had actually made a note before coming on this podcast that anecdotally, that is something that I felt I had noticed where, stocks are making moves well in excess of their expected move fairly regularly. A lot of different names that I was putting screenshots together for a presentation at CSU in a week or two here, was just doing earnings releases and looking at their expected moves. And a lot of them are making big outsized moves compared to what the options market would have indicated. And I think that's a very critical piece for trading around earnings season. With volatility being depressed, stocks making these big swings, it's something to be a little bit careful of. You maybe not be too aggressive or too greedy when seeking that premium, going a bit farther out of the money, giving yourself a little bit more of a buffer to make sure that you're not going to get buried by that big jump if a stock does come out with a good release, especially considering the percentage of firms that came out and beat expectations was pretty well in line with historical averages. It was in the mid 70% kind of range there. So to see them making uniquely big moves like this is notable and something to take into account with strategy and where we select strikes to write during earnings season.
All right, and let's keep on rolling, listeners. A lot to get to in The Buzz.
Busy financial advisors don't have time to follow the latest developments from the options market, so we do it for you. It's time to get The Buzz.
All right, everybody, welcome to The Buzz, the portion of the show where we break down some of the big options topics and stories that you may have missed because you're busy out there dealing with your clients. And we do have a big one that is certainly taking the options and indeed financial world by storm. Before we get there, really quickly, we have to touch on kind of the ongoing saga that has been the focus of this segment for the better part of the last few years, which is, of course, this tidal wave of options volume. Can it continue out there? And we have the numbers, obviously, for February. February, a bit of a weird month this year. Of course, a leap month. So we added an extra day to February, which is probably why the overall numbers are pretty much the way they are. It's a short month, obviously, to begin with. Now, that said, we did threaten 1 billion contracts in February, which is crazy. That's never happened before. 971 million. But of course, remember, we did have that one extra day out there on the month. So that sometimes can gum up the numbers. But still, if you see close to 1B in what is the shortest trading month of the year, typically, things are fairly robust. Again, overall options volume from February of last year up actually a total of 10% on the year. ADV is up about 3% up there on the year. So kind of a strong month out there. Yet again, some other numbers, some highlights. By the way, we are waiting. The numbers for March should be coming in pretty much any day now. A couple of days after you probably hear this. Looking like March probably going to be a pretty strong month as well, but we'll know for sure, obviously, on the next episode when we have the official numbers from our friends over there at OCC. Some highlights from February, though. Index options continue to carry the entire market, up 23.5%. Again, a lot of that on the back of the zero-day fund. If you want to hear the conversation we had about zero-day, maybe the impact it's having on overall volume, is it maybe obscuring some other issues underlying the options market right now? Make sure if you're on the pro side, you check out that panel I did with Mr. Henry Schwartz from SIBO, as well as JJ now running the show over there at IG, as well as our buddy Greg from Amber Data on the crypto side. A lot of fascinating data going up on that session. That's available on our pro side for the pro folks over there. But index options up 23.5%. ETF options also feeling the love, up 6.3%. And the interesting thing, if you look back at the numbers for last year and you dig under the hood past the zero-day index stuff, equity options last year were actually pretty much flat. I think they were up by effectively 1 day's worth of volumes. That's pretty much all they gained last year. So that maybe showed signs that maybe the options growth was cooling. And if you took 0 day out of the equation, we might actually be flat or even down. You come to February of this year, though, and that is not the case. Overall equity options volume up nearly 11%. So a robust time. People are clearly slinging single name options out there again, which is good to see, quite frankly. Nick, we'll start with you. This has been our ongoing saga here on the show, certainly since the pandemic. This just explosion of overall options volume. Obviously, you folks are in the options overlay business, so more volume is good for you folks at the end of the day. What are your thoughts on this protracted growth we've seen in the options market, and do you think this train can continue, sir?
Absolutely. Well, I guess first piece is I do think that it can continue. Obviously, the 0 day to expiration options are, really going to be inflating, especially in the index space, the volumes that we're seeing. But, overall, the general acceptance of option strategies in the public and the advisor space, the number of people that I have conversations with, just, friends and everything that are trading options in their own account has gone through the roof. But I think also, a key piece of it is you can just see the amount of assets that have flowed into derivative income funds. And those funds are obviously going to be driving substantial increases in volume as well. If we have a doubling in our assets, we're going to be trading twice as many contracts, twice as many trades are going to be going off. So I do think that the, growth of the options market and volumes in general will be able to continue going up. Obviously, the 0 day to expiration options, they've really come into their own, I guess, in some ways. And whether or not that continues, I guess we shall see. It's been pretty incredible. I read a statistic recently that there was $1 trillion worth of notional traded on 0 day to expiration options daily so far this year, which is just a phenomenal statistic to come across there. But I do expect options to continue growing in volumes, whether or not we see these, 23% growth figures moving forward. Maybe not like that, but do expect it to continue to be, more and more accepted and more just generally traded in investors' accounts.
Nick, just dovetailing on 0 day there for a second, because we haven't talked to you in a while here on the show. Obviously, it is the buzzword of the options industry right now. As you mentioned, a lot of value, a lot of volume going up in those, including a lot of funds playing in that space now. I'm curious for you folks over there at Shelton, what is your view on 0 day? And as an overlay fund, do you have any use case for these, or is that just too close to the fire for you guys?
I'd say, it's not something that we're looking to get into, frankly. I mean, we're looking to be writing options farther out of the money. That kind of overly active trading, I think, is just not something that's really going to provide much value in what we do specifically. I think that the increase in 0 day expiration trading, I think, is going to be at least in part driven by how many more expirations are available than there used to be. Whether or not we would have had this much 0 day expiration trading, 5 years ago, 6 years ago, 7 years ago, we didn't have daily expirations on SPY a decade ago, plain and simple. It wasn't even something that was available. They rolled out the Monday, Wednesday, Fridays quite a few years ago, but it wasn't that long ago in history that weeklies was as active as you could be. So, it's interesting to see a lot of volume coming through, but there's not really a use case that we see at this point for what we do to add value to our investors as far as generating cash flow, generating yield. It's just a bit too speculative and, like you say, a bit too close to the fire for what we're looking to participate in here.
Mr. Matt, same question for you. Not so much on the 0 day, because you and I have discussed 0 day many times. You're a fan, obviously. You mentioned it again earlier in this show. If you're a 0 day hater, hit up Matt at Option Rats on Twitter. He'll love to have a debate with you out there. But Matt, obviously, this has been the story of the last couple of years, really. In fact, coming up in April will be a 2-year anniversary of this modern 0 day era, which is kind of crazy that it's already been 2 years. But that said, what are your thoughts on this just continued volume growth and the fact that, we saw maybe some chinks in the armor back at the end of last year with flat to really no growth in single name equity options, and now maybe even that trend starting to reverse again, Matt?
Well, every irrational market needs a dream out there, and the AI dream, I think, is starting to drive a lot of this equity option single name. You're getting some just amazing runs in some of these stocks. Reddit just launched, and I of course had to dabble And Reuters called, and I told him, I go, it feels a lot like a meme stock. And of course, it just jammed after that. So, I mean, went from like 45 to 75. So it still feels like there's just irrational exuberance out there, and that's going to drive a lot of contracts. So I think that's what usually goes on in the equity options. And you can see it when you look at the out of the monies for a lot of these kind of IWM type stocks. What you'll see is the relationship in the implied volatility of the like 5 delta to the 75 will start to go towards 1. And what that indicates is, people are starting to pay out for these little lottery tickets. And I think you see a bit of that. Of course, this is still driven by the zero DTEs, and there's a lot, there's been a lot of pent up demand. I've been saying for that. So that's driving it. But I think the AI and the irrational exuberance and the meme type stock feeling out there is back in a smaller amount than we saw before. But that's helping drive things, Mark.
Ah, yes, a lot to unpack there on Reddit. We have to keep on rolling with our other big subject that is really consuming the world of options. I noticed Vol Research kind of back and forth, a lot of contrasting opinions on this subject, which is a journal running with it now too, which is the notion. I mean, Nick was just talking about the growth in these derivatives overlay, derivatives income funds. Call them what you will, and they have exploded. 80 billion in AUM, according to Morningstar at the end of February. It's up from about 7 billion at the end of 2020. So a lot more people, a lot more funds coming in and overriding options out there, which again gets back to our income theme at the top of the show. So now the question comes up, what is the net impact of all this option writing out there? A lot of people are pointing the finger to these funds as the culprit for why volatility is so low. So intriguing debate topic, because there's a lot of counterpoint on this subject going on right now. First off, SIBO came out with a great little macro volatility digest on this exact topic a couple weeks ago, saying, are option income funds suppressing volatility? They point out the same thing. Growth AUM in these funds exploded in the last few years, but they come down on the side of no, pointing out a couple of interesting data points. These are mostly covered call funds at the end of the day. If you were seeing a lot of these covered call funds suppressing volatility, you'd expect the call skew to take a hit as well. And in fact, as Matt kind of just pointed out, we're kind of seeing exactly the opposite. The call skew is bid up to high heaven. So either the retail frenzy is enough to offset what these funds are doing, or perhaps there is yet another culprit at play. They also point out the fact that volatility is anemic across the board, with the exception of crypto and, like I said, maybe energy at the top of the show. You're hard-pressed to find any asset class right now that is really exploding from a volatility perspective. So a couple of the facts there, they say no. And then, of course, a little while later, the folks over there at QVR Advisors, who have been on our volatility show, came out and said, yes, they think it is the option selling strategies out there that they term it, these funds that are suppressing overall volatility. They say have option selling strategies suppressed implied volatility. The answer to this question is unequivocally yes, with an exclamation point. So a little bit of counterpoint. They even use some of SIBO's own data in their rebuttal, if you will, out there. So a little bit of heat out there in the vol space over the past couple of weeks. They say they prefer to call it a structural dislocation rather than suppression, though. And then to top it all off, the Journal had to get into the fray this week as well with an article called "The Short Vol Trade is Back. Why Some Investors Think It's Driving Tranquility in the Markets." They get into a lot of the same data points I just mentioned, the growth in AUM, all these other things in these funds. And they kind of point out the fact that they think it is contributing to this muting of vol in the marketplace. They add an addendum that I'm sure, looking at this is probably the editors probably adding this in to try to jazz up the article a little bit, maybe add a little bit of quote-unquote clickbait. I don't think the reporters would go down this route. Maybe. I have to look to see who wrote this over there at the Journal. But they point out one reason for concern, they say, that this could maybe lead to a reprisal, a return of Volmageddon from 2018. They point out that was a short vol event as well that blew up in the face of the market, ended up wiping out a lot of these funds. What they don't point out in this article is that these are mostly covered call funds. The risk profile of these extremely different from an old XIV. But I guess you have to have a little bit of clickbaity stuff in your article at the end of the day. I'm glad they talked to our buddy also just on Vol Views last week, Mr. Jim Carroll. They asked him in his article about that, and he kind of laughed that off. So I'm glad that they talked to some saner heads out there. But a lot of data to unpack, a lot of point counterpoint. This is very much the topic du jour in the world of options and indeed volatility. So I want to go around the horn, get each of your thoughts. Nick, as our guest, we'll start with you. What are your thoughts on this debate? Do you think this massive growth in AUM and these derivative income funds is to blame for the quote-unquote suppression of volatility we're seeing right now? Or are there perhaps some other culprits to blame out there?
I mean, I think that it's hard to argue that the increase in covered call writing funds could be suppressing volatility premiums to an extent, but I don't think it's an apt analysis to say that it is the entire driving force behind it. Like you say, volatility has been uniquely low recently, but not just in equity markets. It's across asset classes, it's kind of across the board. And then, as Matt said earlier here, the IV of SPY relative to its components, he said was around 45%. Volatility has been very low, especially on indices recently. It's been quite muted, but single stock volatilities haven't been muted to that same extent. And a lot of these covered call writing funds, certainly there are some out there that write index options and 1256 contracts and, against SPY, but there are also a lot of them out there that are writing individual equity options. So if they were the primary driver, in EQTIX, we're not writing index calls. We're writing calls against the underlying securities. If that was really where all this volatility suppression is coming from, you would expect to see more of that reflected in single stock volatilities than just in the indices. And I think, again, it's been across the board that volatilities have been deflated. So looking just at derivative income funds as a source for that suppression is ignoring, I think, a lot of these external factors and these other components of it's outside of what we're focusing on and what we're trading that we're seeing this volatility suppression, kind of across the board here. So, I would fall more on the CBOE side of no, that it's not directly the responsibility or, coming from covered call funds themselves. They may be a contributing factor, but they're certainly not the driving force behind, low volatility across the board here.
Matt, same question for you. What are your thoughts on all these kind of conflicting data points and kind of the interesting nugget I think the SIBO pointed out early on in this debate that you would expect maybe to see the call wing taking more of a hit than it is right now, maybe reflecting some other factors are at work. But what are your thoughts on this point counterpoint on the whole low vol debate, sir?
Yeah, I mean, the point at that I think is reaching. You got the Fed with a bunch of money out there, and I mean that's such a huge elephant in the room that it's hard to point at anything else. Probably, that's just a distraction. So it's the market. I mean, it's just going straight up. There's not much historical volatility. When we look at just kind of historic implied to historical volatility ratios, it's right around, pretty normal. So it's not doing anything to that relationship. Yeah. And then, like you said, and I mentioned earlier, if that were the case, you'd expect to see the calls really driven down. And it's the opposite right now. It's more of the meme stuff going on. It's these 5 delta IWM, which is, these small are really bid up. And so, if you really drill down to the numbers, that argument goes out the window pretty quickly, Mark.
Yeah, a lot of the data coming actually from that same source over there at SIBO, crunching the numbers a few weeks ago as well, showing that you're right. The skew in some of these names and indeed across the board in general is starting to return to 2021 meme stock levels. So again, not the setup you would expect if it was all of these covered call writers just completely depressing overall market volatility. I think it is fair to say there are probably some other culprits at work. Otherwise, these same covered call writers must be crushing the heck out of vol in pretty much all assets across the board to have similar vol movements out there. But what do you folks think out there, listeners? Maybe it might be a fun. We already have 2 questions of the week going for you out there. It might be a fun, maybe a follow-up question. Are you folks buying what a lot of folks out there in the vol space are selling? That these option selling funds are to blame for vol being fairly muted, or do you think perhaps something else is afoot? Hit us up, let us know. Speaking of you folks hitting us up, we got a little bit of time left. Let's see if we can squeeze a few of you in, a little bit of the old office hours.
It's time to answer your pressing questions about options. It's time to start our office hours. You can become a part of this segment by leaving a question on theoptionsinsider.com, emailing us at questions@theoptionsinsider.com, or via social media at twitter.com/options, facebook.com/theoptionsinsider, or stocktwits.com/optionsinsider.
All right, everybody, welcome to the office hours segment. And as that transition was playing, I did manage to track down our question of the week from last week, actually. So very near and dear to the topic we were just discussing, which is quite simply, what is your primary reason for trading options? At the end of the day, a little over half, 54.2% of you, came down on the same side as those funds, income premium harvesting. So a lot of you are chipping away at that vol a little bit out there. Maybe you're to blame. You're the reason vol is so depressed. Followed by, I should say, speculation. So that would be all that upside call bidding up that we were just talking about, as well as other use cases out there. That is almost 40%, 39.6% of you going the speculative route, 6.3% only for protection or hedging. So no love for protection or hedging out there. Our actual question of the week right now, also an interesting one, bit of a contentious one. Quite simply, as Q1 draws to a close, which market segment are you the most excited about for the rest of the year? And excited can mean many different things. Usually it means outlook for underlying performance to the upside, but it could mean a lot of different things. We purposely left it vague. I gave you three choices in the infamous other: equities, crypto, volatility, or other. And right now, volatility, again, going back to what we were just talking about, taking it. 38.1% of our audience excited about the opportunities in the vol space. What are you doing? Are you trying to harvest what little premium is left? Are you trying to maybe take a swing for the fences to the upside and VIX? Hit us up, let us know. Crypto, a third of you going for crypto. Only 19% for equities right now, which is very surprising, and 9.5% for other. A lot of you wrote in for treasuries or fixed income, so a lot of you enjoying that out there right now. But that's our question of the week. Get out there right now, add options, and make your voice heard. If you're listening to this after the fact, as I know many of you are, weeks, months, years down the road, head on over to Add Options anyway. Chances are it's a great question of the week for you to make your voice heard on there right now. We got a lot of great questions. Let's go to this one. He's been waiting for a while. Mr. Lincoln, or perhaps Lincoln, says, my go-to option strategy is to sell covered puts on stocks that I want to buy and then get paid to wait. If the stock comes my way, I eventually trade out of it using a covered call. So a little bit of the old wheel trade. What do you think, savvy or stupid? You know, Nick, we were talking about your overlays and your covered calls. I didn't get a chance to ask you about your thoughts about puts as an income trade as well. So maybe let's start there. Do you guys over there at Shelton have a use case for selling puts as an income component? And then what do you have to say here for our listener, Lincoln, who likes to use the old wheel trade? What are your thoughts on that one, sir?
Mm-hmm. Absolutely. So, we do have a use case for this. We actually have a separately managed account SMA strategy that does pretty much exactly what he's speaking to, writing puts to enter a position, and then once you've got the equity position, turning around and writing covered calls. And I think it's certainly a good trading thesis to go in with. I also think that if a stock is at a price where you would feel comfortable buying it, it may make sense to be a bit more aggressive with the puts you're writing, simply because if the stock then makes a run, you've got limited upside. You've only got that premium that you receive that you can really make. If a stock makes a big move up, it can get out of the price range you're interested in buying it at. And, you can miss out on some pretty sizable returns there as well. You're not going to get the dividend. You're not going to get that upside. So I do like the strategy. I just think the only caveat would be, if the stock is not, too far above your target entry point, maybe be a little bit more aggressive with the strike on those puts that you're writing. Give yourself a better chance to take on the equity, which would then open up some additional upside potential once you have the equity position. And if the equity then makes a run and you never end up taking on that position, you generated a bit more return while doing so. So I'd like the trade, just with a small caveat there.
Mr. Matt, same question for you. We talked about the wheel before, but it's been a little while. What are your thoughts from Mr. Lincoln, who's effectively legging into the wheel, perhaps without even knowing it, Matt?
Yeah, as you know, I'm not a huge fan. We are doing extensive back testing on the wheel now, so that's been a lot of fun. And actually, it looks pretty decent. But I mean, the market's been perfect for the wheel. As an old market maker and someone that's been around the markets too long to even mention, eventually these short puts come and bite you, and you don't really get paid, I think, what they're really worth. And so I'd rather do like at least some type of a diagonal, some type of a put spread, something to protect yourself in case something big happens. And I think a lot of these people that look real smart, when they start getting bit by these, they start going to put spreads. So it's kind of funny to watch, not funny, but sometimes sad to watch. And then the cover call, you have to really be nimble. You have to be a pro at it. That's why, it's interesting to, hear what's all going on in this show. You have to be a pro in order to trade these cover calls at the right spots. I mean, we've done millions of cover call back tests, and it's not what you think, not just selling the 30 delta 30 days out. That's often the worst. You give away, these stocks, they move, a couple days, and that's their entire appreciation. So you really have to watch out by selling calls. That's another thing where you might want to think about a cover call. So that's how I feel about the wheel strategy, Mark.
All right, so we'll have to leave it there. That music means another great jam-packed episode of Advisor's Option is in the can. If you folks have thoughts on any of the stuff we touched on today, including our great vol debate, maybe generating income in these high-rate, low-vol environments, the wheel, all sorts of fun things we touched on, the ongoing tsunami of options volume out there. Can it continue? Hit us up. You know where to find us on most of the major social media outlets at Options. Of course, if you can, questions at theoptionsinsider.com also works. Or if you're listening on the live, of course, on the pro side, get those questions in via the live as well. But before we go, let's go back around the horn and see what everyone else has cooking up that may interest you. We'll start with you, Nick, as our guest. What are your thoughts? And of course, if our listeners want to check out what you folks are cooking up over there in the land of Shelton, where should they go? What should they do?
Go into our website, sheltoncap.com. Great place to start. Certainly look at any of the research, Morningstar, et cetera, on EQTIX, our fund, and find a lot of data there as well. So a lot of information out there, and really appreciate you having me on again, Mark.
Happy to do it. Check them out for yourselves over there, listeners. Shelton Capital, and Nick's fund there is Equitix, EQTIX. A covered call strategy. If you want to check it out, you can find it, of course, Morningstar, all the other places that they evaluate all those funds. And Mr. Matt, if folks want to kick off some back tests or maybe have a fun, if not scary, chat with Otto, where should they go? What should they do?
It's great to be on with Nick and really marry up the back testing that we've seen with true experience in these calls. So that was made for an interesting listen, and come over to orats.com. I mean, it's really the dashboard's really moving in leaps and bounds. We talk about the 4 pillars of trading being research, execution, risk, and review. We're adding to all those. The review, we're adding a journal. To the risk, we have just great slides that you could look at, risk slides, and then in the execution where our scanners and everything, and we're tying in with different brokers so you can see all your brokers, and then of course on the research, that's where we really shine with the back testing and such. So come on over to orats.com. I'm Matt at ORATS, so look forward to hearing from you guys.
Of course, you know where to go to check out the options volume numbers we were talking about, maybe some of their great education. Our friends over there at OCC, in particular, optionseducation.org, where you can get a lot of great data they produce over there, a lot of great educational content as well. That's going to do it for us on the network today. Back again tomorrow with a double dose of education in the form of a live doubleheader of Options Bootcamp. You don't want to miss that if you're hanging out in the pro. That'll be coming at you. Why wait a week to hear both episodes? You can hear them both tomorrow. TheOptionsInsider.com/pro is the place to go. to get access to all that live and a whole bunch more. And then back with our usual array of content throughout the rest of the month until our next episode of The Advisor's Option. Stay safe out there, everybody.
The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit ORATS.com or email Matt Amberson at matt@orats.com. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.